Okay, good evening, everyone. The time is about 7:05. We are getting ready for our Corporate Connect webinar. So do give us a few seconds more for a few more attendees to stream in. I'm seeing that there's quite a lot of you today for today's webinar. Okay, so let's start now. A very good evening, everyone, for joining us today on our Corporate Connect webinar. This webinar is organized by SIAS and supported by SGF Group. And my name is Sunny. I'm from SIAS, and I will be your host for today. So today we welcome OUE REIT, which is a well-known REIT in Singapore, as well as our audience from various investing platforms, as well as on YouTube. So allow me to do a very quick introduction on the company or the REIT that we are featuring today. Okay, OUE REIT is one of Singapore's largest diversified real estate investment trusts with 5.8 billion Sing dollars in asset under management. Its portfolio includes 6 high-quality properties, 3 office assets which are in the CBD area, 2 hotels, and of course the Mandarin Gallery, which is a premium retail mall along the Orchard Road shopping belt. And with a triple B minus investment grade rating from S&P Global Ratings, OUE REIT with very stable and diversified exposure to Singapore key commercial and hospitality sector. We will kick off today's webinar with a market highlights from Maybank about the REIT sector in Singapore, followed by the corporate presentation by OUE management team, OUE REIT management team. Okay. Thereafter, then we'll do the Q&A segment. Okay. So before we dive deeper, let me welcome Mr. Krishnan from Maybank to take us through some of the key highlights in the REIT sector. Over to you, Mr. Krishnan.
Thank you very much. Thank you for giving me this opportunity. Glad to be with the panelists as well as the attendees. First, let me share my slides. If you can give me a couple of minutes. Are you able to see it properly?
Yes, we can see the slides perfectly now.
Thank you very much. So yes, so I will give a quick update on the Singapore REIT sector overall, just the performance, what's driving the whole sector, and also the recent news flow. Before obviously the management of OUE REIT will take you through the REIT itself and give the outlook of the future outlook. So without taking much time, first up, the year-to-date returns. I think the Singapore REIT sector overall had a rough time over the last 3 years, especially when the interest rates were on the up following 2021. But since this year, the interest rates have started to climb down, and that has benefited the sector immensely. In addition, the Singapore REIT management also has been quite active in pursuing the various value-up strategies by divesting non-core assets, reconstituting the portfolio, and future-proofing their portfolio. So this together have helped the Singapore REIT sector. And as you can see in the slide, the Singapore REIT sector is up about 17% year to date, and they are outperforming the regional peers except for Japan. The STI index, yes, it has outperformed the Singapore REIT index, but that has been because of the few performance from some of the large caps like DBS and ST Engineering. So net, I think it is looking bright for the sector, and the REIT investors who have taken much of the beating over the last few years are enjoying the fruits of that patience now. The next slide basically goes what I was talking about, the interest rates and benchmark yields. So the dark chart, basically dark line basically shows the 10-year yield, Singapore dollar government 10-year yield, and the light chart shows the benchmark rate, which is the 3-month SORA. So year to date, the 3-month SORA, as you can see, has fallen by about 160 basis points, and the 10-year yield has down by about 90 basis points. Quite a bit of decline has happened over the last since in the second half of this year, and we think our house view is that this is because of the safe haven flows, and we expect this to continue. So right now, the 3-month SORA is at 1.45%, and we expect this to decline to 1.1% by year end, and then by next year end to about 0.7%. We view the next 10-year yield to stabilize at the current levels. So net with the base rates declining, this will help the REIT sector to lower their financing cost, which directly flows through distribution to your hands. So this is a positive influence for the sector. And the second thing which I think which matters to investors is basically how much does the sector give in distribution and dividends compared to other similar instruments with not much of risk taking. So as you can see, the Singapore REIT index is giving out 5.4% yield right now compared to 4% for the STI. And in terms of other risk-free rates, they are between 1 to 2%. So there is a healthy spread of about 3.75%, which is close to the historical peaks and definitely helps you to beat the inflation, which is coming down. So overall, the REIT index right now offers a healthy spread versus other risk-free similar instruments. The next slide basically tells about what I was mentioning earlier in terms of the yield spreads. So the chart on your left basically plots the yield spread since the start of this decade. So you can see from 2021 onwards, the yields did expand after the recent performance of the REIT sector. The yield spread has come off, but it is still giving a healthy yield spread of about 3.5%. And in terms of the price to book, the discount has narrowed, but it is still trading below one-time book. So overall, the valuations are not too stretched despite the 17% return that you see year to date for the sector. And for the specific REITs, this is for the overall aggregate sector. If you look at the specific REITs, then there is a wide spread in terms of these valuation metrics as well. This chart talks about the fundamentals. Earlier, I had talked about what's driving the flows and what's driving the valuation. This basically talks about how the dividend for the overall sector looks like. It plots the dividend that is given by the REITs, which is in our coverage. We cover about 20 names, which is bulk of the sector market cap. We have market weighted them and basically plotted the distribution that are given by those REITs since 2020. As you can see, 2022 was the peak, and this was when the interest rate started climbing. And it started to come off, and the street and us are expecting that the distribution will slowly start to grow once again, since they will benefit from the refinancing of the debt in the low interest rate period. Further, I think our house view is that the GDP growth for this year will be resilient at 3.2%. For the next year, we are projecting 2% right now. So we are still on the GDP growth overall is resilient. So the REIT sector will also enjoy the healthy top line, and combined with the falling interest rate, this is driving the overall distribution growth in the forecast period. This is the quick update on what are the recent news flow that's impacting the sector. The first thing is the liquidity. This has been some of the concerns that is there for the small and mid cap names, as well as including REITs. But I think the Singapore SGX and the authorities have launched the IES Singapore Next 50 Index. This index includes our 48% weightage to the real estate, of which 44% is constituted by the REITs. So this should enable, and we are seeing the initial effect of that in terms of the turnover of some of these names. Before I go into subsector updates, I would like to highlight the last point, which is the REITs pursuing the value up. So even despite the interest rates coming down and the liquidity enhancing measures taken by the authorities, the REIT managers themselves are actively pursuing their capital management and asset management. So in terms of divesting the non-core assets and bringing down the gearing, some of the REITs are at the forefront, and you will hear more about that. They are also divesting some of their subscale assets and the fully value assets to further future-proof the portfolio. So it is not just top-down, but also bottom-up effort by the various REIT managers, which is helping to reap the benefits. So very quickly on the subsector updates, overall, we are seeing the rents and prices growing for the various subsectors at a different pace. So the industrial rents and prices have grown by about 2% and 5.5% year on year on the second quarter respectively. The overall export index has been a bit soft, but our house view is that the sharp and extended trade downturn is quite unlikely, and this has been more of a pronounced effect from the tariffs. For the retail rents, this again went up by about 1.3%. The prices are up by 2.4%. And retail sales, as you have seen, this has grown by 4% year on year for 2 consecutive months. F&B is also growing, but to a smaller extent. Similarly, office, we are seeing spot rent growing, but I think the price index has been a bit patchy. And the net absorption for office space has been positive in the second quarter. The tourist arrivals have picked up. So over the last 2 months, we have seen a 5% year-on-year growth in tourist arrivals. Hotel occupancy rate similarly has grown about 1.3 percentage point and is right now above 90%. So overall, I think the subsector updates has been healthy, and combined with what we have seen, the macro impact of lower interest rates and the various efforts taken by the REIT management, it is quite likely that the investors will get the distribution, will finally see the distribution growth which has been missing over the last 3 years. Finally, the summary slide about why investing in the Singapore REITs. Again, those who have been investing, the first few points are pretty well known. It has been an established sector over the last 20-25 years. The birth was not easy, but since then the sector has grown. There's a strong regulatory framework supporting the sector. Strong currency, MAS has an appreciation stance, and we are seeing the safe haven flows. The deposit growth is about 11% year on year. So all this benefits the overall market and the REIT sector as well. The safe haven flows are supportive of asset values. We are seeing the cap rates to be quite stable for all the properties. And the last 3 points are the points that we mentioned before, the lower interest rate, which is supportive of the distribution and sector valuation. The operating metrics are resilient across all subsectors. And finally, management are pursuing the various value up strategies. So overall, it's a healthy sector, and which is looking poised for a rebound from the various top up as well from the bottom up and the top down factors that I have described just now. With that, I will hand over it to Sunny to take us to the next section, which will be the presentation from OUE REIT management. Sunny.
All right. Thank you, Mr. Krishnan, for your in-depth sharing on the REIT sector. Definitely looking promising for this sector with the interest rates coming down, and then the DPU is looking promising that it will move up in the next couple of quarters and couple of years. So with that, we'd like to thank Mr. Krishnan today for sharing with us. We will now move on to the next section, which is the corporate presentation. Okay, so let's welcome Mr. Han and Mr. Lionel, who are the management team from OUE REIT. Okay, so thank you, Mr. Han and Mr. Lionel, for joining us today. I will pass the time over to you now to start your corporate presentation and give us the latest business update on OUE REIT.
Thank you, Sunny. Krishna gave a wonderful presentation and overview of the REIT market currently. So I think that leads us nicely into our section of the presentation. Okay, so basically, OUE REIT, we have 6 assets, and all are in Singapore. The picture you can see there essentially reflects the all our assets. So we have 3 office assets. So from top left to sort of clockwise. Okay, we have another sort of better view here. We have the OUE Bayfront office, One Raffles Place, very iconic, sitting on top of the Raffles Place MRT station, downtown office next to the Singapore Stock Exchange. And then we have the Hilton Hotel. It's 1,080 rooms. It's the largest Hilton in Asia Pacific. It sits on top of the Mandarin Gallery, which has a very long, over 150-meter frontage onto Orchard Road. Excuse me. Plus, we have the 575-room Crowne Plaza, Changi Airport at Terminal 3. Okay. So total assets under management, 5.8 billion. And as Sunny has mentioned earlier, we're very proud of our investment grade rating, BBB- from S&P Global. So these are some of the market endorsements. So 7 analysts cover us. We're on a number of global and local indices, as you can see here. Plus, we also have, over the last few years, garnered several awards and also recognitions. Okay. Now, a little bit about us and why sort of Singapore commercial and hospitality is where we're focusing our energy and our portfolio on. So Singapore, here, as you can see, it's first in the world in political and operational stability, economic competitiveness. FDI is really big in Singapore. And sort of what is very interesting is actually the bottom right table. You can see family offices growing exponentially in Singapore. So there was 100 family offices in Singapore in 2017, and it's now grown to over 2,000 family offices. So now these are not just family offices from North Asia, but they're also coming from India. They're also coming from the Middle East. They're coming from Europe, and also a lot of them are also coming from the US and North America. So there's a proliferation. And post-COVID, we also see a lot of the very large institutional funds and also very large pension funds from North America, from Europe, from Middle East, setting up offices in Singapore as well. So there's a nice ecosystem for fund managers and also family offices now that has built up over the past several years in Singapore. In terms of CBD, why do we like the office market? Basically, what you can see here is the occupancy has stayed stable above 90%. And if you look at from first quarter 2023 all the way to second quarter 2025, Grade A rents have continuously gone up at quarter on quarter. So we see this trend continuing. You may ask why? Why do we believe it will continue? If you look at the supply from so this year onwards until 2028, there's actually no new supply in the core CBD space. So demand stays stable, but supply is diminishing, and we will see organic growth within companies. So this higher occupancy and also strong rental growth will, we believe, remain in place for the next couple of years. Government has come out to say they'll be not doing any new government land sales within the CBD for the next couple of years. So again, no supply. And even if there was a government land sale, planning, permits, design, construction, it will take 4 to 5 years to go from zero until a building is ready to be occupied. So we see very little supply over the next few years coming through. Okay. And Singapore, so why hospitality? Singapore sits within ASEAN. ASEAN is 700 million people. And Singapore sits within, it's also a key destination for Indians and also for the Chinese. So if you add that up, we're looking at close to a 3 billion population just from ASEAN, India, and China. And these countries, we're seeing a growing middle class. So which means when people have a bit of money, they start traveling to nearby destinations. And we believe this macro trend of increased travel as as the income of the middle class continue to grow and the middle class actually continues to grow. Hospitality will be a key driver in the region, and we want to benefit from that. And we're well positioned with our 2 hotels in Singapore. So in terms of upside, year to date, we are sort of still trending a little bit behind the sort of 2019 number. We expect to close the year at 18.5 million visitor arrivals. That was achieved in 2019. The number of room growth, the hotel supply is fairly stable. So again, we think the supply demand dynamics remain healthy. Okay, so we've had a couple of concerts, the F1 weekend, and it's obviously working quite nicely, and in terms of events for Singapore. So we see Q3, Q4 being strong, typically strong quarters for Singapore hospitality, and then we do believe the trend will continue for this year. Okay. Now, why OUE REIT? So what is our offering really? We believe we are we're defensive because our assets are all located in prime core assets. We have revenue resilience because our 3 office buildings are all in the CBD grade A locations, and we have the 2 hotels. One, the Hilton, is obviously within Orchard Road, a very popular destination. Crowne Plaza benefits from the improved connectivity of Changi Airport. So again, that's quite strong. On the other side of it, we do like we have this upside where we see hospitality growth coming through. So we'll want to benefit from that. And also, the hotels have a master lease agreement in place by our sponsor. So for the Hilton, it's 45 million, and for the Crowne Plaza, it's 22.5 million a year. And during COVID, in 2020, 2021, 2022, we benefited from this 67.5 million minimum rental guarantee in place. Okay, so now for diversified, a little bit about our portfolio here. We have a diversified tenant mix. There is no sort of over reliance on any single one sector. The largest sector is banking, insurance, and financial services, and we see in terms of leasing activity, in terms of leasing inquiries, this remains a very strong sector still. For lease expiries, we've been able to renew a number of our leases for this year. There's a rather large lease expiry next year, which we're working on. Hopefully, we'll have further news to update, but it's leased to a large tenant at quite low rents. So if they were to stay, great, we will renew them. If they were to move on, we do see quite a lot of positive rental reversion in place as well. Okay. And moving on next. So we have, if we look at our DPU, that we've seen growth in our DPU on a year-on-year basis in the first half for both the core DPU, which excludes capital distribution, and also if we do include the capital distribution. Our current distribution yield is 6.5%. And we believe this is a healthy number, which we'll continue to be able to achieve. Yeah. So on the next slide, if you look through our performance in terms of revenue, it's been fairly stable even through COVID. Now, obviously, COVID, we had the master lease agreement, minimum rent protection kicking in. NPI has been stable as well. So we see that, look, this is the sort of the beauty of having a very prime core asset. It's very resilient. Yeah. So finance costs have declined significantly. Year on year. Lionel will take us through the capital management strategies and what we've been able to do recently. Okay. In terms of Singapore office, very briefly, we have committed occupancy of 95.5%, very healthy. Average passing rents is 1086. We've had 12 consecutive quarters of positive rent reversions as well. So second quarter was 9.1%. And we see, very importantly, if you look at the bottom left chart, our sort of for this year, next year, our average expiring rents are 1086 and 1029 respectively. Now, currently the CBD grade A market rents are $12.10, which means we're still a little bit below the market and we can still continue to enjoy positive rental reversions. Okay. With regards to the Mandarin Gallery, occupancy remained healthy at 99%. The rental reversion was very positive for the second quarter at 34%. So if you look through committed occupancy throughout the years from 2019 until sort of year to date, it has remained fairly healthy above the 90% mark, actually mostly above 95% as well. During COVID, obviously a little bit stretched on the longer term leases, but we're able to backfill that space with some short-term pop-up leases. If you look at the average passing rents, we believe it has bottomed out in 2022 and it's on a slow upward trajectory. And that is very much in line with visitor arrivals and the pace of visitor arrivals coming through to Singapore. And moving on next, this is a little bit about what we've done at the Mandarin Gallery. We've had a Labubu pop-up that was very well taken up. We recently had a rosé merchandising. Ed Sheeran also came through with a pop-up merchandising as well. And obviously, this past week has been F1. So we've been able to drive through a lot of traffic into our mall. Okay. And yeah. Sorry, slight technical issues with my laptop actually. Okay, for the hospitality segment, the first half of the year has been a little bit a bit stressful with regards to the hospitality segment. And then performance has been a little bit under. Again, part of it was due to a high base effect. And so first half of last year, we had Coldplay concert, we had Taylor Swift, we had a number of Bruno Mars, Ed Sheeran coming through. Whereas this year, there were a lot less concerts and events in the first quarter of the year. So we did see that impact in terms of lower revenue and lower NPI. Obviously, Hilton being in the prime core location, we see that impact stronger because of the location. Crowne Plaza actually, on the converse, has benefited from inclement weather, which has caused flight delays, wars, volcano eruptions, has meant flight delays, which actually does benefit the Crowne Plaza. So a tale of two cities there, but we do believe on a longer term basis, both hotels are well positioned to drive the performance that we expect for our portfolio. Okay. And moving on. So these are some of the sort of pictures of what we've been able to do. We did a pop-up. So we did a tie-up with Kidstopia at the Crowne Plaza Changi Airport in terms of aviation family suites. So these are $900, $1,000 a night, and they've sold out very quickly. So parents are nowadays do spoil the children, and the children really enjoy these kind of suites. Crowne Plaza Changi Airport, actually, we're proud to say and it has won for a 10th consecutive year the world's best airport hotel by Skytrax. So that's an achievement we're really proud of. Okay, and moving on, I'll hand this over to Lionel.
Thank you, Han. Yep. So as Han has shared earlier, we have an investment grade rating, triple B minus from S&P. So what we have done is we have been able to leverage on this our IG rating to lengthen our debt maturity profile by tapping on the longer tenor bonds, and also to reduce the cost of debt by creating the competitive tension between both the banks as well as the bond market. So currently, in terms of aggregate leverage, we are at 40%. That's because we haven't used the proceeds from the divestment of Lippo Plaza Shanghai. So if we were to use the proceeds to pay down the debt, the leverage will come down to 37%. So currently, we're still watching for investment opportunities. So in the event that there's no investment opportunities, what we'll do is we'll use the proceeds to pay down the debt. So in terms of the cost of debt, we are currently at 4.2%. We were as high as 4.7% end of last year. So we have seen that reducing. We have basically seen the peak rates already, and we have turned a corner. We expect to see the cost of debt trending downwards. So if you look at the recent bond issuance that we have done, it was a 7-year bond issuance. We leveraged on our IG rating. Got a lot of institutional support, and we were able to tighten and issue the bonds, 7-year bonds at 2.75. So essentially, what it means is that if we were to reset all our borrowings right now, we will definitely be able to achieve sub 3% sub 3% in terms of our cost of debt. So we have to wait over the next 1-2 years as some of our interest rates roll over, and we reprice it and mark to market. We'll be able to achieve that kind of cost of debt. In terms of the unsecured borrowings, we are currently at 87%, as well as the unencumbered assets. So just to give a bit of color of what we have done in the recently, since we have announced our first half results, we have refinanced the OUE Bayfront loan. So you look at the chart, that's basically the purple bar, 311 million. So that was done via a 5-year loan, refinanced into 2030. And what we have achieved is that we have actually reduced the margin on that loan by close to 50 basis points. So that will actually contribute the savings for us going forward. So that was done in August. And then what we have done in September recently, I think just last week, as I mentioned earlier, we did our we issued a 150 million bond, our second 7-year IG green bond. So the coupon was at 2.75%. Last year, when we issued, it was at 3.9%. So you can see that we have seen 115 basis points compression in terms of our bond for this 7-year. So all this, as I mentioned earlier, will help us to drive our cost of debt down, and as what Krishna shared, will benefit us over the next 1-2 years, as the interest rates starts to come down. Thanks.
Thanks, Lionel. So on why we believe we're well positioned, look, we believe in the story that we want to be best in class asset. And really that benefits, if you look at what's happening with gold is believed to be a strong sort of safe haven, and we've seen actually gold currently, if you look at the market, outperforming the semiconductor index actually, which is quite rare. Again, there's a flight to quality, and we do want to be a REIT that provides that to our unit holders and our investors. So three key areas. So one, we believe Singapore is a safe haven, and having our assets currently, or the majority of our assets being in Singapore, we benefit from that. We have a downside protection through our master lease agreement for the 2 hotels. So hotel provides the upside, but obviously we've kept the downside by having the master lease agreement of 67.5 million in place. Lionel has talked through a lot about how the decline of Sora and Krishna as well. So, I won't delve into it, but we do see a lot of tailwind coming from that effect. Now, with regards to our assets, why do we believe it's defensive? Again, well diversified, no concentration risk with regards to assets by value, or also by revenue, fairly well spread out. We have a barbell strategy in place. If you look at the middle pie chart, so 50% of our income is from stable 3-year leases in office. Hospitality, obviously, we're able to push our room rates up when demand is strong. Retail, we see coming back when visitor arrivals improve coming through Singapore. Okay. Now, in terms of decline in SORA, look, we've seen the decline in SORA, and we've seen interest expenses. As obviously as SORA moved up very significantly starting the second half of 2022, peaking out by the middle of 2024. It's significant jump. And now we're seeing it come off, and as our swaps roll off, we should see this number in terms of interest expense coming down. Okay, so touched on earlier, look, this is where SORA is with regards to how fast it has moved downwards as well from 2024 September until today. It has dropped nearly 2.1%. Yeah, so for those of you who are invested in treasury bills, you've seen that also decline dramatically. Fixed deposits doing the same in the bank. So REITs are able to provide this sort of 5-6% returns traditionally, and we do believe for us, for OUE REIT at least, look, we think that the supply demand dynamics for our office, our retail is positive. We think hotels over medium longer term will continue to grow, and we're seeing a declining cost of debt. So overall, very positive views for us actually over the next 6, 12, 18 months. So three key areas which we focus on really on a daily basis. Number one, maximize asset performance. So making sure that we get the right tenants, the tenants stay, we maximize our occupancy, we get the right tenant mix in the Mandarin Gallery, environmental credentials. So Green Mark in Singapore is very important. So we continue to work on that. Asset enhancement initiatives. We had completed $250 million asset enhancement for the Hilton completed in 2023. And also we undertook a $22 million asset enhancement initiative for the Crowne Plaza Changi Airport, which we also completed in December 2023. So the capital structure, Lionel has talked a lot about, but what I think you have to remember is investment grade rating. There are not that many REITs with investment grade ratings. So investment grade rating basically gives assurance that we're able to be quite stable. Rating agencies take a look-through approach. So they are looking through the next 12, 18 months with regards to their ratings. So I hope this provides you assurance that the REIT is well managed. We're in a good position on the capital structure. In terms of pursuing value creation opportunities, we took advantage last year to sell our Shanghai asset as we believe the supply demand dynamics there was not favorable, and we believe the asset will continue to drag. So we are able to divest that. We're currently focused on looking at offices and hotels in Sydney and Tokyo only, very specifically, and again in prime locations. So really that's what we're focused on the three key areas. Again, look, Singapore-centric portfolio, and also focus on the two main cities, because we believe these are the two cities that will continue to grow. Okay. So really, key takeaways. Well, we're very well positioned for growth. We're well diversified. There's income resilience. We have a 6.5% return for our dividend yield. So again, it compares very favorably with where fixed deposits are, where T-bills are currently. Again, our assets in prime core locations, so strong demand continuously. There's very little supply, so that will hold up the rents and also occupancy. Visitor arrivals, Singapore government manages the supply-demand dynamics well. We have gone from no investment grade rating to investment grade rating over the last couple of years, and we are, value creation, and we've been able to prove we were able to execute on the asset enhancement initiative for the Hilton and also for the Crowne Plaza, and we're seeing positive returns on that, and we'll continue to look at what else we can do to improve our whole portfolio. Okay. That covers our presentation. Happy to take questions. Thanks.
All right, thank you, Mr. Han and Mr. Lionel, for taking us through some of the latest update from OUE REIT. Do stay with us on the line. We would now move on to the Q&A session. So audience on our YouTube platform, you can actually click on the link to join us in Zoom so that you can post your questions in the Zoom chat. And for audience already in the Zoom, you can post your question in the Q&A box as well, okay? So we endeavor to answer as many questions as possible, okay? So Mr. Han and Mr. Lionel, let us move to the pre-submitted questions first. There were quite a few very sharp questions. I'll pick out one of those. And that first question will be the unit holders or the members of SIAS would like to understand what is OUE REIT's strategy going from here in terms of divestment or acquisition. What are the plans and roadmap to increase the AUM and the DPU yield going forward in the next few years?
Okay. So if we look at 2022, and after COVID, so right before COVID, there was the merger of the two REITs, the hospitality and the commercial REIT. The idea behind that is to grow in scale. Scale matters a lot in REITs because you have better access to cheaper financing, you have better access to opportunities, better trading volume, liquidity, etc. So scale mattered. Now post-COVID, so coming out of COVID, we're able to, with a larger scale, take the Hilton offline and to do the refurbishment. Fortunately, it was done during a period where demand was very low because it was through COVID. So we got quite lucky, able to do that. And we saw actually performance of the Hilton 22, 23, was 24, even the first half was strong. Okay. So that reflected the correct decision with regards to rebranding and also investing on the asset enhancement. The hotel was getting very tight also. We also added on a couple of rooms around the pool at the Crowne Plaza as part of the asset enhancement, which we undertook in 2023, and also refurbished the F&B offerings. And that again, we've seen the performance of the Crowne Plaza coming through. So these are the various things which we try and do. Now, Shanghai, we like the asset, but it was getting old. There was no certainty with regards to would we be able to renew the leasehold? No, yes. So it was hitting the 20-year mark. It was an older building as well, already requiring capex. There was a large oversupply situation where it would have taken 8 to 12 years to work itself out in Shanghai. So we thought, look, this is the best time. We exit, and we exited at a 5% discount to valuation. Now, in the context, I think it's very important to understand the fact that we were able to exit. There were a lot of the big US private equity funds still stuck in Shanghai, and they were saying, look, we'll sell at 35, 40, 50% off valuation, but there were no takers. Yeah. So there were very, very few transactions in Shanghai, and we were able to execute on that, and we are very proud of that. And when we were in Hong Kong, seeing a number of the fund managers, that was one thing that they kept telling us. Look, you've proven the team, the manager has been able to execute on divestment in a very, very difficult market when everyone's trying to get out. Part of that is also because the location is very prime asset. So again, there was a very small demand, but there was demand to exit. Okay, so that basically proves that the strategy of the portfolio works where we are very prime core assets. So if we do need to exit, at the worst of situations, we can still exit, right? Okay, so with regards to growth, now obviously we've recycled that capital. We're looking very closely at Sydney, at Tokyo, and we do think the opportunity probably for Sydney is better than Tokyo. In Tokyo, There's a lot of capital chasing Tokyo. Tokyo is super hot at the moment, so we'll take a sort of more wait and see approach. Whereas in Sydney, there is the interest rates are still high. It's still sort of 4%, 5% there. And there are not a lot of transactions, but we think now in the next 12 months it's a very, very good opportunity to invest there. The Singapore dollar is at a historical high versus the Australian dollar. Currently, interest rates haven't been cut, so when interest rates do get cut in Australia, it may be this year, maybe next year, maybe following year, but you'll see tailwinds there. There's been very little supply being built up through in Sydney as well, because through COVID, nothing much was built. So we think that the dynamics there are positive, and and we'll look very closely at trying to do something in either Sydney or Tokyo.
Okay, thanks for that answer. Really looking forward to positive developments over there if there's possible acquisitions in the future. Part of that previous question was about the dividend yield. Maybe I can expand a little bit on that. Is there any payout ratio policies or some kind of a yield projection that we could the REIT will foresee in the next few years?
Yeah, no, I mean, look, we can't give a forecast. It's very difficult even for us to forecast because we don't know where SORA is going to be, because interest expense is a very large component of it. We can see, like, rents for offices are likely to continue growing. Over the medium longer term, we do believe hotels will continue to perform. Mandarin Gallery will continue to improve with visitor arrivals, but the large sort of expense really is interest expense. If trajectory continues to go down, then yes, it's very likely we're able to maintain these levels, right, of dividend yield. But so that's probably as much as I can share with you, because that's as much as as we can see, as far as we can see, with regards to crystal ball. Sorry, your other question, Sunny, was
Yeah, is there any policies on the ratios?
yeah. So we, as a REIT, we're mandated to pay out at least 90%. So we try and pay out as much as we can. Right.
Right. Thanks for that answer as well. I think that gives investors a lot of reassurance on that, because definitely even the analysts are looking at the interest rate coming down. So definitely there could be positive developments on the DPU, the payout in the coming years, if let's say the trajectory continues to stay true to what was projected. Okay, let's move on to the next question. Mr. Han, you talk about acquisition in Australia, in Sydney, in Japan, Tokyo. What about Singapore? Any plans for Singapore?
I mean, Singapore is our core market. We'll continue to look at it, but Singapore, it's interest rates have come down to a point where accretive acquisitions can take place. But we really want to buy sort of best location, prime assets. So it's quite hard to come by, and these are trading at probably 3.5% yield. So not very accretive at this point in time. It's obviously possible there are assets in the market at sort of mid-4, 5%, but not really the type of assets we want. So we understand our investors are concerned about dividend yield. So again, buying into assets which are very prime core allows us to deliver a consistent dividend through the years. Yeah.
Okay, yes, I can really see that as well. Looking at the asset portfolio, they are really prime asset in the CBD, in the prime town area district. So it's actually Singapore as a small place is really very challenging to look for a creative property in the Singapore prime areas. Moving on to the next questions. One of the the unit holders would like to ask, does the REIT manager foresee any rights issue or corporate actions that could be coming up in the coming year?
No, look, we're trading at quite a large price book discount, so it doesn't make sense for us to do a EFR or rights issue, because it just dilutes it, and it doesn't really help with regards to making sure our unit price continues to grow, which I can see some of the concerns there. So one of the thing is, look, we have to sort of stop doing dilutive EFRs. We have to show our investors, unit holders, which we're doing the right thing, which in my view, in the last couple of years during COVID, there was no opportunity to acquire and very difficult to also sell. Okay, so we worked really hard on our capital structure, and we've moved things forwards a lot. right? And now in terms of our cost of debt, we are very competitive. We have an investment grade rating. So it's all in that positive direction for the capital structure. In terms of asset portfolio reconstitution, we sold out of Shanghai because the dynamics were wrong in our view. And we are looking obviously at at Sydney, at Tokyo specifically, yeah, Sydney and Tokyo only, because again the prime core location, because we believe over the longer term, the dynamics there are positive. Okay, so we hope to show our unit holders, our investors, stakeholders, like that's the way to grow, and 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 we hope to execute on the vision. So please be a bit patient. It does take a bit of time to execute, but I think we've shown a good track record over the last 3 years. And I see a question there. I'll just take it. So with regards to how much in Sydney, how much in Tokyo, asset size, it will be quite opportunistic. Really, again, the focus is freehold, ideally new or fairly new, so very little capital expenditure. Again, very prime core location. So that's really our criteria. And we really would like to keep at least 70% of our portfolio by value within Singapore, then 30% outside, and how much of it in Sydney, how much of it is in Tokyo. Again, we take an opportunistic approach for that. Yeah.
Hey, Ken, thanks for the answer. I think you hear that from the management. The core of the portfolio will still be in Singapore. So I think that will provide a lot of stability for the REIT as a whole. Yes, Mr. Han, you are right also. There are quite a lot of questions streaming in from the Q&A. So let's do some quick answer questions. One of the question was, given that you mentioned the challenging conditions in the Chinese markets, that's why the diversification happened. But given the long-term projection, how do you look at China? Would there be a chance, or that you foresee maybe in the next 5 years that there is a chance that OUE REIT might go back into the Chinese market?
I mean, currently we don't see that happening, but I mean, you never say no, but all I can say is, look, in the next 1-2 years, it really is Sydney and Tokyo. The Shanghai, really, it'll take a while to work itself out. So, I mean, if we do go in, we're not rushing in to get in.
Yeah, we do understand that. I think we can see as well the property sector conditions in China is not the best optimum time right now, and it could take a year or two maybe for things to play out before things starts to sort of see any rebound in property sector. Okay, let's move on to the next question from a certain Mr. Nor. He's asking, is the strong Sing dollar affecting any of the REIT's performance or even the hospitality sector?
Yeah, I mean, for sure, it's over the past 1 year, the Sing dollar has appreciated, and that has impacted the hospitality industry as a whole in Singapore. It's gotten very expensive. A lot of that is obviously because Singapore is seen as a safe haven, so a lot of funds flow into Singapore, and MAS has to keep pushing the base rates down. That's why you see a disconnect, and MAS has started moving base rates down so much faster than the Federal Reserve. Yeah, and even then, on that basis, the Sing dollar is appreciating against the USD still. So part of the Sing dollar's strength is because it's a happy problem, I guess, where it's because Singapore is viewed as a safe haven, really.
Okay, thanks for that answer. I'm looking at another question relating to inflation. Inflation is coming down, but it's still elevated, we would say. So with this rising cost pressure in manpower and operating expenses, we would like to understand how OUE is positioning or managing these headwinds or these challenges in terms of high cost and expenditure.
Yeah, so we took the very difficult decision back in late 2022 to increase service charge for all our commercial assets. There was a lot of pushback in late 2022, but we executed on the increase in 1st January 2023. So that buffered us quite significantly as well from 2023 to 2024. Actually, I would say the rising cost pressures has actually eased off for us. We're seeing utility rates starting to drop. The rate of increase for manpower is sort of slowing, especially for materials, etc. When during the COVID, when there was when the supply chains were disrupted, yeah, we saw costs shoot up, but we see a lot of reversal of that as well. The Trump tariffs, yes, it has it has impacted, but at the same time, what we've seen is because the Chinese producers are losing market share in the US, they are quote unquote sort of targeting Southeast Asia as their market, and that actually has capped inflation because they are quote unquote dumping their overproduction into Southeast Asia so that they can clear their stock. So that has kept as well some of the rising pressures within Southeast Asia. Singapore has also seen that impact coming through. Yeah. So I think it's very much sort of manageable with regards to that. Obviously, using more automation, using robots, more CCTVs. So all these are savings in hotels. We have obviously if it doesn't detect movement in the room or there's no one in the room, electricity, utilities all cut off within sort of 10 minutes. So all these are the little things we do. And obviously upgrading of our chillers, etc. for as we progress through the green mark recertifications that lowers or makes the consumption of energy a lot more efficient as well in our building. So that will cap costs as well. And SORA's coming down, and interest expense is the bigger cost for any REIT.
Yes, got a good point there with chasing a better ESG rating. That also helped the REIT to manage costs as well on that side of things. The time is 8:01 already. We are 1 minute past the 8 p.m. time, and I really thank the management for staying back with us to answer so many questions of yours. Let me just round up with the final questions. I do see a lot of questions regarding the capital markets, the share price performance. So I'll just round it up. But I'd like to give credit first. Have a quick look at OUE REIT share price. Year to date is up 20%. Since the April low, the tariff low is up about 40%. So it's a wonderful performance this year. But past year was quite bad. So is there any actions on the management side to sort of look at how the share price or the unit price and the capital performance in the stock market right now for OUE REIT?
Yeah. So look, so as we were going to share price performance, if you see, so right after the merger picked up, that was late 2019, and then we ran into COVID. So obviously in COVID, having offices where people didn't go to work, having hotels where tourists were not allowed to travel, that really impacted the share price, the unit price. So, and then if you fast forward, as we're coming out of COVID, there was a lot of negativity on office because people were saying, "Oh, work from home is a permanent feature." I remember back in 22, we were in Korea, we were in Hong Kong. No one wanted to talk to us about office. Everyone said it's a terrible asset class. So, can you please not talk to us about office? And then hotels is well, we're still not sure about quarantine, so not very exciting. 23, office again was quite negative. But hotels, because Singapore started performing, became interesting to investors. They're like, "Oh, okay, talk to us about your hotels." But again, there was overhang on our share price because of the office. So we had, overhang because of office and hotels, and then overhang because of office, and then hotels got a little bit better. And if we move forward to sort of 2024, 25, actually this year, we were in Bangkok, we're in Hong Kong, we're in Tokyo. Everyone wanted to talk to us about how great Singapore office is and how much further growth it can come through. And they saw the performance of the hotels and is it a temporary slowdown or is it a structural slowdown? And do we think it'll start picking up? So, so we're seeing actually, investors believe, look, people are back at work and they believe that story now. So having offices in prime core location is great. And hotels are coming back, and plus interest costs are coming down. So the negativity on REITs with the interest cost coming sort of rising, it's gone, it's coming down. So all the REITs will benefit from that. And again, our office will start to benefit. Now it's just a hotel needing to show the performance. And because of that, you can see, this year it has improved our unit price performance. So that's sort of the short history of why it hasn't performed.
Yes, indeed. You brought out some of the good key points that we need to take note of why the stock price was pressured. And I think in your presentation earlier, the numbers really speaks for itself, especially in the past few quarters. We can see that the positive rental reversion and the outlook that any new rental renewals would likely bring the rentals up for OUE REIT as well. That would be something that unit holders should be looking forward to because that will help to bring out more distributions for unit holders. Lastly, I'd like to thank Mr. Han and Mr. Linus for joining us and staying back with us today to indulge our audience and unit holders with the questions. That gives us a lot of better understanding into OUE REIT. So I'd like to thank you again for joining us today. We would like to thank our audience as well. Thank you for joining us this evening with your precious time. We have come to the end of this Corporate Connect presentation. We hope that everyone today found this information that was shared by the management team very useful and informative. And in case if you missed any of today's session, you can actually rewatch this on our SIAS YouTube channel. And also do visit our website to get more updates on upcoming investors, education programs, and webinars. Our next Corporate Connect session will be an exciting one, held physically on the 14th of October, Tuesday, featuring Hong Leong Asia. So do remember to register and sign up for that, and I'll see you there. So thank you once again, Mr. Han and Mr. Lionel, for joining us today. And thank you all the audience. Thank you and have a good night. Take care. Goodbye.
Thank you, Sunny. Thanks, everyone.
Thank you.